What happened here, and this is, I guess, a good way to explain the hows and the what's
Yes,
ups.
please.
When you think of what a bank does, basically, is it takes in deposits, and I'm oversimplifying dramatically, but a really plain vanilla bank, George Bailey, takes in deposits from depositors and lends them out to to businesses and individuals for mortgages, for business loans, et cetera, et cetera. That really is like the It's a Wonderful Life idea. Now, the problem is deposits are by nature short term. They're called demand deposits, which means I can demand them back at any given moment. On the flip side, though, there's not a lot of liquidity in someone's business, in Mr. Gower's pharmacy, let's say. You can't necessarily call that loan right away. So the banks there's a certain fragility in this. They're borrowing short term and they're lending long term, and have to appear safe and solvent, so that too many people don't demand their money back. What happened in this case of Silicon Valley Bank is a lot of their customers got a lot of money. Think of all the money that's sloshed around in the post-COVID world. And I'm not just talking about stimulus checks going to people. I'm talking about investments in SPACs,
Right.
and all sorts of IPOs that maybe shouldn't have happened.
And it
So there
is,
was a lot.
it is fair to mention that the bank itself, most of their clients were businesses, right? So
Yes.
businesses got more PPP loans or whatever loans from the government during COVID. So they had an influx of cash.
But it's way beyond that.
Right.
Well, these are corporate transactions,
Okay.
or companies doing their banking. Roku had $460 million in the bank.
That blew my
Circle,
mind.
the stable coin, had $3.3 billion at the bank. So, we can argue whether that money sloshing around in Circle should be there or not. I will say that crypto as a whole is a easy money phenomenon, shall we say? And so there was that kind of money going around looking for a home. Well, the bank pays interest on those deposits. So what did the bank do when it got all this money? It didn't necessarily lend it out to, in the case of mortgages and other corporate loans, because these companies didn't need business loans so much necessarily. So the bank put it in what appeared to be very safe securities. They bought treasury bonds for the most part, or government agency mortgages. There's not a lot of credit risk on those, theoretically zero, but there is duration risk. So remember about that part about borrowing short and lending long. Well, the problem is, even in the case of something like government bonds, which are very liquid, relatively speaking, they are subject to price fluctuation. And so you had short duration borrowing and long duration lending. Now, remember, so assets. And so the assets on their books, as rates rose, if you buy a bond and prevailing interest rates rise, bond prices fall. And so they had to keep ratcheting up the price of their deposits, or at least stay in line with the market. But meanwhile, the value of their assets was falling. And this is what happens. You've heard the term inverted yield curve, meaning that rates in the short term are higher than rates in the long term. Well, if you're borrowing at a higher rate than you are lending, that's not a recipe for success for banks. And these guys got caught up in liquidity. It wasn't credit. Most of the global financial crisis was a result of silly credits, banks lending to people who shouldn't have had mortgages, or all sorts of crazy schemes. In this case, their loans were going to the government, which is not a particularly productive thing necessarily, but they got them marked against them. And so when people wanted their money back, they had to sell down some of these long-term bonds.
Right. And they just sell them at a loss.
And they sold, well, not just a loss, $1.8 billion loss. And that, of course, got people's eyebrows raised. What's going on there? How bad are their books? Let's take our money out. And that's when it became sort of the old-fashioned bank run. And that's what the Fed and the Treasury had to step in and take care of. I think they were hoping to do it over the weekend. They like to deal with problem banks over the weekend, but circumstances overtook them and they had to close it down on Friday.
Well, that makes sense though, right? And when you think about it, it makes sense that this would happen really on a Friday afternoon. So the markets close over the weekend. They can kind of prepare and make a plan, because otherwise it would just crash the next day. like almost like that. Whereas suppose Monday they can plan and some things out. So that totally makes sense to me.